There are a few things I look at when it comes to reversals to know if the reversal will work or not. The first thing that is very crucial when it comes to reversal, this one is very basic and almost everyone knows it, is candlesticks patterns. Candlesticks are literally everywhere, both on paper and YouTube. If you can understand candlesticks very well, it will help you a long way to accurately predict where price will likely go next. What if I told you that there are some specific candlesticks that I have been trading over the years of managing over 300 different accounts, making consistent profit without any single one of those accounts being blown? In this video, I'm going to be breaking down 4 most important candlestick formations, how to recognize it, the psychology behind it, and the best way to take trade with it. Stay tuned. Welcome back. In candlestick patterns, we have 2 types of candlesticks, the bearish candlestick patterns and the bullish candlestick patterns. So I am going to be unveiling the first one, which is doji. The bullish candlestick for doji is the dragonfly doji, while the bearish candlestick for doji is the gravestone doji. Here is how you can recognize the dragonfly doji. The dragonfly doji does not have a real body, and it looks like a letter T. Its appearance is being preceded by a downtrend spotted at the bottom of the chart or at a support level. Each time you see dragonfly doji at the bottom of a chart or at a support, it is telling you that sellers are tired of selling the market and the price is about to reverse to the upside. Now let's look at the psychology behind the dragonfly doji. When the market opened, the bears started pushing the candlestick downward, but later in the day, buyers gained momentum and they started pushing the same candle upward to a point that the candle closed at the same open price, leaving a longer lower wick. So both the open price and the closing price of a dragonfly doji are the same, but it has a longer lower wick. So the longer the lower wick, the stronger the buying pressure and the weaker the sellers. Traders do look at dragonfly doji at support region, then they start buying the market because they know that the strength of the buyers is now emanating from the weakness of the sellers. Here is how we trade it. First, you need to look at dragonfly doji at areas of support, not necessarily at the bottom of a chart, though sometimes it is stated to be at the bottom, but then any value support region is okay. When you look at this, sellers were selling this market. Coming to this level, a dragonfly doji was spotted here. After this dragonfly doji, we need to look at the level, if it is a support level, if it is respecting a previous support. So when we look at it, the market has respected this level before this dragonfly doji was spotted. So after spotting the dragonfly doji, how do we take trade? We need a full-bodied candle to close above the high of the dragonfly doji. So I put a line at the close of the confirmation candle that closed above the dragonfly doji. At the close of this candle, I will go long and I will put my stop loss below the low of this dragonfly doji, and my take profit will be ×2 of my stop loss. We still have another example here, same dragonfly doji. This market was dominated by sellers. Sellers pushed this market to this level, but later in the day, buyers gathered momentum and they started pushing this price upward to a point that this market closed at this point with a longer lower wick. This is a sign that sellers are getting weak and buyers are gaining momentum. So what do we need before we take entry? We need a bullish candlestick confirmation that will close above the high of this doji candle, and this candle closed above the high of this dragonfly doji. At the close of this candle, we can take a buy and the market bought. So this is actually how we go about trading dragonfly doji. The next candlestick formation that we are going to look at is the gravestone doji. The gravestone doji is a bearish candlestick formation and it looks like inverted letter T. For the signal, the gravestone doji to be valid, it should be spotted on top of an uptrend or at a resistance zone. What happened here is that buyers were totally in control of this market. When this candle opened, they keep pushing the candle higher. But later in the day, sellers came in, gathered momentum and started pushing the same candle down to the open price. So at last, last, both the open price and the closing price are the same, just like we have here in the diagram. Both the open price of the gravestone doji and the closing price are the same, leaving a longer upper wick behind. The longer the upper wick, the stronger the selling pressure and the weaker the bias. Because gravestone doji is formed at resistance, most traders will like to sell after spotting it. If we look at this market, the market has been dominated by buyers. Up to this point, a buy candle printed, but later in the day, sellers came in, gathered momentum, and brought the price down with a longer upper shadow, signaling that the uptrend is weak. The next thing that we need to take entry is a bearish candlestick confirmation that will close below the low of this gravestone doji. And this is the candlestick that confirmed. So we put a line on the close of this confirmation candle, and after the close of this candle, we take a sell and we put our stop loss above the high of the gravestone doji, while our take profit will be at least ×2 of the stop loss, and the market really sold. The next candlestick we are going to be looking into is engulfing candlestick formation. The buy candlestick for the engulfing is the bullish engulfing, while the sell candlestick for the engulfing is the bearish engulfing. The bullish engulfing candle is spotted at a support or at the bottom of a chart. The pattern consists of two different candlesticks of opposite color. A small bearish candle followed by a long bullish candle that opened far below the close of the bearish candle before closing above the bearish candle, thereby completely engulfing the bearish candle. If you look at this diagram, this market was dominated by sellers up to this point, but the next candle that was spotted was a big bullish candle that opened far below the close of the bearish candle before closing above the open of the bearish candle. This signal weakness in downtrend. The psychology of the bullish engulfing candle is pretty straightforward. The first bearish candle of the engulfing implies the control of sellers after a prolonged downtrend. Then suddenly a big bullish candle appeared and engulfed all the activities of the bears, indicating that the bulls are now in control of the market. And to be sincere, traders really do care about bullish engulfing. Bullish engulfing candlesticks patterns, they are really powerful. And what happened after? The market reverses and started buying. So how do we trade bullish engulfing candle? First, it should be spotted at a support after a long bearish move, but not necessarily at the bottom of the chart. This market was dominated by sellers. A bearish candle was spotted here, but later a bullish candle opened at the close of the bearish candle before closing above the open of the bearish candle, thereby engulfing all the activities of the bears. This is a signal that the bears are weak and buyers are fully in control of the market. So the next thing we need is a bullish candlestick confirmation that will close above this candle that make up the engulfing. And the candle next to the candle that make up the engulfing was a bearish candle, so which is not it. So the next candle that was spotted was this bullish candle. So at the close of this bullish candle, we take a buy. If you look at it very well, this pattern is happening in an area of value. It is happening at a support zone. So we put our stop loss below the support. The next one is the bearish engulfing. Bearish engulfing is found or is spotted at the top of the trend or at a resistance after a period of prolonged uptrend. During an uptrend, price gets to a resistance and printed a small candle. Then suddenly, a strong bearish candle opened above the close of the bullish candle before closing lower than the open of the bullish candle, thereby engulfing all the activities of the buyers. This signals weakness in uptrend, which is a sign for bearish trend reversal. And what happened? The market reverses and started selling. So how do we trade the bearish engulfing candlestick pattern? First, this candlestick pattern should be spotted at a resistance after a prolonged bullish move. So you will first spot a small bullish candle followed by a large bearish candle that completely engulfed the body of the preceding bullish candle. That shows that buyers are getting getting weak and sellers are gradually taking over the market. The next thing we need to do is to wait for a bearish candlestick confirmation that will close below the sell candle. After that, we take a sell and we put our stop loss above the resistance, while our take profit will be at least ×2 of the stop loss. And the market really obeyed and sold. So after this class, start looking for these patterns at areas of supports and areas of resistance. And trust me, if you follow these candlestick patterns the way it is being explained and trade it the way you are supposed to trade it based on this video, you will have a good trading history. If you find any value in this video, encourage me by clicking the subscribe button below the video and also turn on the notification bell so that whenever another interesting video is being released, you will always be the first to be notified. Don't forget to drop your comment at the comment section. Also smash the like button and share this video for others to see. Thank you and bye for now.